Good morning and welcome to Financial Accounting for the Spring 2022 semester. We are starting today on Chapter 2, Analyzing Transactions. So we've led into this a little bit in Chapter 1 as we talked about those questions that need to be answered for every transaction, the recognition, valuation, and classification questions that I mentioned in class last time. But today we're going to actually start with what does this look like? How does information get into our accounting records in the analyzing transactions? So you can see we have a number of learning objectives that we will be working our way through. The focus of this chapter is on journalizing transactions and posting transactions to the account. So how does the information get into our accounting records? How do we know if it belongs there in the first place? Those questions that we're going to be asking. In the reference materials in Blackboard, I've already showed you the two reference material pieces, and I guess I should probably do that again. So let me go show you those. The two reference materials that are related specifically to this chapter are introduced in this chapter. Are actually on the main page of the reference materials. They're not in the Chapter 2 folder. And the reason they're up here on this first level is because they're so important, because they are information that provides the foundation for every other skill that we learn in financial accounting. So the only things that are in the Chapter 2 folder, there's one page here with some information that you can read through that I put in there in response to a couple questions that I was getting. And then I will be replacing the video links with the videos from this semester. So the only other, whoops, sorry, I need to be jumping around. So there are no other reference materials in the Chapter 2 folder because these, the accounting equation expanded with normal balances, and we're going to learn today what that means. And then the required form for a journal entry, again, we'll be using that today. So this information is directly from Chapter 2, but it is so important that I want it right here on the top of the reference materials folder so that you have it immediately available at your fingertips. Any questions before we get started? All right, so we're familiar with the fundamental accounting equation, assets equals liabilities plus equity. We talked in Chapter 1 about what a transaction is. It's something that affects the financial position of our company. We know if something affects the financial position of our company, that it is by definition a transaction, and therefore it needs to be recorded. So we've heard all of that terminology before. What we are learning in this chapter is how does that happen? How does this information about a transaction get into our accounting records and affect our accounting equation? I had mentioned the term account, and we've talked about account titles in Chapter 1 as well. We've already learned some very normal, typical account titles such as cash, accounts receivable, accounts payable, common stock, retained earnings. I think we may have talked about inventory and supplies. We also have accounts for property, plant, and equipment like buildings and land and equipment. Each one of those account titles belongs to an account. An account is the smallest unit of storage within our accounting records. When you look at the financial statements for the company that you have chosen for your annual report project, what you're seeing are generally going to be summaries of smaller, more precise or more detailed accounts. What you see across the top of this slide, and don't worry about the numbers, we're not worried about those right now, but what you see across the top is an example of the fundamental accounting equation expanded, where we can see individual account titles. So assets, we have examples here: cash, supplies, and land. Liabilities, they have just one: accounts payable. And then equity is everything else here. Now last week, I had drawn a line right here, basically, and told you that to the left of this line are what we call the permanent or real accounts, and to the right of this line are the temporary or nominal accounts. These accounts, dividends, then we have a revenue account and a bunch of expense accounts. Those all affect stockholders' equity. All of those accounts affect our retained earnings. Now you'll notice that retained earnings is not included here in this list, and what that tells me is this is a brand new company. They didn't have any retained earnings prior to these transactions. So permanent accounts to the left, temporary accounts to the right of that line. We talked about last class as we were finishing up chapter 1 about how some transactions would increase or decrease various accounts, and we talked about the impact on total assets, total liabilities, total equity. We saw that every transaction must affect at least 2 accounts, but it didn't have to affect 2 of the types of accounts: assets, liabilities, and equity. In other words, we could have a transaction that made one asset increase while another asset decrease. So both of the accounts were assets. But we know that every transaction that we record needs to keep this whole equation in balance: assets, liabilities, and equity. And today we're going to learn about how we do that. How do we make that happen in our accounting records? So accounts are the smallest unit of storage. For our purposes, we are frequently going to use something called a T account. And that's what you can see up on the screen, the T account. This is out of the way for people in the classroom. So the T account is named that, you can tell why, because it starts with just a giant T, capital T. And it has 3 parts to it. Now, I should point out that the T account is something that we use in class. It's something that I think of it as something that we use for notation or on scratch paper. You're making some notes, you're just trying to figure something out in your head, and you're jotting down ideas on your paper. When you look at an actual accounting record, you do not see something that looks like the T account. This is something that we use just to draw things out and be able to picture what's happening or what impact does this have in our accounting records. So the T account starts with that giant T, and then it has 3 parts to it. The first one is on the screen right now, the title. And so across the top of the T, we would write the account title. Again, we've already talked about some very typical common account titles: cash, accounts receivable, inventory, supplies, land, buildings, equipment. Over to the liability, the most common liability that we've talked about is accounts payable, but any other payable, bonds payable, notes payable, interest payable, salaries or wages payable, interest payable, taxes payable, income tax, property tax, and so on. Payable. Most, if not all, of our liabilities include the word payable in there, so that we recognize, ooh, that's something we owe to someone outside the company. And then in the equity section, common stock and retained earnings are the permanent equity accounts that we have from now until chapter 12, when we'll introduce a couple others. And then we have our temporary accounts, dividends, revenues, and expenses. So across the top of the T, we would write the specific account title, whatever it is. And then underneath the T, we have a left side and we have a right side. Do not ask me why in accounting we do not just call them the left side and the right side, but we don't. Instead, we refer to them as the debit side and the credit side. I find this very useful actually because I think I have a mental block and I struggle with left and right. I have to stop and think about it every time. Oh wait, this is left because I'm right-handed. This is my left. I don't know why. Debit and credit, I get. Left and right, I've had an issue with since I was pre-kindergarten. So I'm okay with them calling it debit and credit because I get those. That mental block with left and right. For you, though, you're going to have to learn that. Debit just means left. Credit just means right. It does not mean good or bad. It does not mean add or subtract. It simply means the left side and the right side. The other thing that you have to know is that we use abbreviations for these. And there's not a lot of room for me to put it in here, but I'm going to try. Because these are the abbreviations that you will see on materials that I provide to you, and they'll be the abbreviations that I use. So the abbreviations that are used in accounting for debit and credit are DR and CR. I had a master's degree, I worked in accounting, and it never once crossed my mind why we abbreviated debit as DR when there's no R in debit. Never wondered. Never even gave it a thought. It's just how it was. I think it appealed to my sense of balance. Oh, they match. DR and CR, they match. The reason we do that, now that I teach accounting, I had to learn some of these things that aren't really relevant in the field. But the reason we use DR and CR is they're actually the abbreviations for the Latin words. So accounting was first developed by a friar, Fra Luca Pacioli, and he worked in Latin. And so these are the abbreviations for the Latin terms for debit and credit. We use the English words, debit and credit, but the Latin abbreviations, DR and CR. Interesting things you learn in accounting class. So you'll see me use these abbreviations, DR and CR, and for a little while, for maybe the next week or two, I will generally write in the DR and CR when I write a T account, when I draw a T account, to remind you, the debit side is the left-hand side, the credit side is the right-hand side. Okay. Any questions so far? So T account has a title on the top and a left side and a right side. So how do we use that left and right side? Well, to talk about this, I want to go back to that. There we go. I want to go back to what I have here in Blackboard for you. And I'll see if I can make that a little bigger so that you can see it better. So what you see on the screen right now, if you look at just the equation part, not the T account part, you look at the equation part, we already know this. Assets equals liabilities plus equity. Common stock and retained earnings and revenues all have a plus sign in front of them. Dividends and expenses have a minus sign in front of them because the more we pay out in dividends, the less equity we have left. The more we spend on making money, those expenses, the less we have left in equity. All of the others have plus signs. Dividends and expenses have minus signs because they reduce our equity. So that is not anything new. We learned that really in chapter 1. The part that's new today in chapter 2 is what we see here in these T accounts. So Retained earnings and dividends are both account titles. The others are summaries. These are types or categories of accounts. So you would not see a T account that just says asset on it. We'd need to know which asset. Is it cash, receivables, inventory, supplies, and so on. Same is true for liabilities, revenues. Common stock is also account title. The revenues, expenses, assets, liabilities, we would have a specific account title on there, not just that generic category or type of account. Now what I want you to focus on that's new this chapter is what you see underneath the T. So you see the labeling, debit, credit, all the way across, debit on the left, credit on the right. What I want you to focus on now though is the plus and the minus. So each one of these accounts has a plus on one side and a minus on the other side. The side that has the plus sign is referred to as that account type's normal balance. It's the side of the account we use to increase that account. I do not have a magic way for you to remember which type of account increases on the debit or the left side, which account type increases on the credit or the right-hand side. There's no magic to it. I will tell you, I'll give you a hint that might help you to remember, but until you are sure that you know this, you're going to want to refer to this page, maybe print it out, maybe kind of bookmark the page where you find something similar. Now, what's in our book does not look exactly like this. I prefer the way this is, nice and neat in one row. I snipped this from another source, but it is, you'll find the same information in our book. It's just not as neat, I don't think. I don't like it as well. So I would encourage you to keep track of this, maybe print it out and have it available. I used to, when most students were on campus and we had a hard-covered book, I used to pass these out, just a little strip of paper, and suggest that you use it in a bookmark in your textbook. I don't even have any with me. But so now that we have ebooks, you don't need a bookmark the same way as we used to use. So it's here for you in Blackboard at the top of the reference materials folder. And please just get in the habit of referring to it until you are absolutely positive that you know this inside and out. And that will happen as you continue to work with it. But if you get it backward, if you forget and get it wrong, you're going to make everything else you do in that problem wrong. So it is really important that you get it right. And so please use this as reference. And here's my mnemonic, my memory tool for you. This is the best I can do. If someone else comes up with a better one, feel free to share it with me and with the class. So assets, the way we typically write the equation, assets equals liabilities plus equity. Assets are on the left hand of the equation, the left-hand side of the equals. And so assets increase on the left hand or the debit side. And we can see that because that's where the plus sign is, right? On the right-hand side of the equation, we have liabilities, common stock, retained earnings, and revenues. And I'm skipping dividends and expenses because they have that minus sign. So liabilities, common stock, retained earnings, and revenues, you'll notice they all increase on the right hand or the credit side of the account. Dividends and expenses, because they reduce equity, they have the opposite normal balance. Dividends and expenses, you can see, increase on the debit side, just like assets. So it is important that you know the normal balance in order to record a transaction. You have to know what two or more account titles are involved. And we, again, saw that a little bit last class, identifying which accounts would be affected. Now you know which side of the account, the debit or credit, the left or right side of the account is used to increase or decrease those accounts. One more rule, and we'll go back to our PowerPoint. One more rule, every transaction that we record must have at least one debit and one credit. So we already knew at least two accounts had to be involved. There has to be at least one of them that's debited and one of them that's credited. If we have just two accounts, we call it a simple transaction. And there would be one debit and one credit, and the dollar amounts that are debited and credited will be equal. They have to be. If we have more than two accounts, we call that a compound transaction. And so you might have, if there were three accounts involved, you might have two debits and one credit, or one debit and two credits. You might have 8 accounts that are involved in the transaction and 4 that are debited and 4 that are credited, or 5 and 3, or 6 and 2, or whatever. Any combination is fine as long as there are at least 2. Most of the transactions that we deal with will be simple transactions where we have exactly 2 accounts. In total, the dollars that are debited and credited for every transaction must be equal. As long as that is true, as long as you have equal dollars debited and credited in every transaction, then your equation will stay in balance, your whole system will stay in balance, and I will be happy, and you will be happy. So, as we get into transaction analysis in this chapter, we'll be using those T accounts. We'll learn how to record transactions, how to balance the T accounts, find the balance after we've recorded transactions. Remember, I gave you last class those 3 terms, and I'll put those on the screen again to remind you. The 3 terms, the 3 questions that need to be answered are recognition, what date do we put on it? Valuation, what's the dollar amount? And classification, what are the 2 or more accounts that are going to be impacted by this transaction? Now we know that once we identify those accounts, we'll be able to record the dollar amounts on the debit or the credit side, depending on whether those accounts are being increased or decreased by this transaction. So as we think about each account title, and this is explained here in the text underneath this graphic. As you think about each account title, you're going to be asking yourself some questions. So I know it's the cash account, but what type of account is that? Oh, it's an asset. So if it's an asset, it increases on the debit side. It decreases on the credit side. First come up with the account title. Figure out, ask yourself what type of account it is. These are the options. All of these across the screen here are the only options that exist for now. These are the main options. And we're going to ask, what type of account is it? Okay, because it's that type of account, how do I increase it or how do I decrease it? Okay. Any questions so far? Okay. So let me just go back quickly to our PowerPoint, and we'll take a look at this T account where they have already recorded some transactions. And again, don't worry about where these dollar amounts came from for now. But before we go to our exercises and get started on our exercises for today, I want you to see an example. So as we pointed out in class last time when we were talking about transactions and accounts that would be involved, and would it be increased or decreased, we saw that the cash account came up more often than anything else. And so in this cash account, this is fairly typical that we have a bunch of debits, 2 actually, and a bunch of credits, we have 4. In order to balance the account then, after you've recorded all of your transactions, in order to balance the account, we add up the debits another word here on the screen. We add up the debits, and that's called the debit footing. Black. So for this exercise, they kind of left this step out. I wish they hadn't. But we should add up the debits and credits. So we add the debits. Okay, that would be called the debit footing, 32,500. It really should be on the same line with what I'm about to put over here, which is the credit footing. But they didn't really give me enough room to do that. So now I'm going to add up the credits. Hopefully I added those right. So we have a debit footing, 32,500. This is the cash account. So that represents the total amount that was put into the cash account during the period, right? We put $32,500 into our cash account, deposited. And we took out $26,600 from that cash account. So how much do we have left? We put in 32.5, we took out 26.6. If you think about it, you already know how to do this. You already know how to balance an account. You just don't maybe know it by those terms. We put in 32.5, we took out 26.6. How much do we have left? Well, we subtract. 5,900 is what we have left. That's the balance in the account. How do we know which side it belongs on? Well, we have a hint because the cash account is an asset account, and assets have a normal debit balance. And so we have an expectation. If that's the normal balance, that's what we would normally expect to see, right? But how do we know for sure? Well, the dollar amounts that were debited, the footing is higher than the credit footing. So we find the debit footing, we find the credit footing, we subtract the smaller number from the larger number to find the balance, and we record the balance on the side that had the larger footing. Okay, so those are the steps involved in balancing T accounts, and we'll see this again. So this is really just your preview, your first glance at how to balance an account. So what I want to do now is go to our first exercise for the day. Any questions? So I'm giving you just a moment in case you do not have your chapter 2 exercises open. Please go to those now. If you recall, I told you that most of the time we will do all of the exercises together. But there are a couple exercises in this chapter that are what I think of as multiple choice questions, because we have a drop-down list and you just have to pick the correct answer. So for those, we will do some of them together just to make sure you understand what it is you're doing. And some of it I will leave for you to complete outside of class on your own. You always have to check my work so you can see how you did. Of course, if you have any questions, you can always ask. You can ask at the beginning of class on Wednesday. You can ask by email or during office hours or whatever works for you, before class, after class, whatever. So we'll start with number 1, and this is one of those exercises that is a multiple choice question, so we're not going to do this entire exercise together. There are some that we are definitely going to do together though, because they're maybe situations we haven't encountered yet, so I want to make sure that you're thinking about this correctly. Hopefully everyone has had a chance to get your chapter 2 exercises open. So let's see what this exercise says. The following accounts appeared in recent financial statements of Delta Airlines. Identify each account as either a balance sheet account or an income statement account. So it then goes on to tell us which type of accounts those would be. So for balance sheet, it would be an asset, a liability, and an equity account. For an income statement account, it would be a revenue or expense. For me, it makes sense to answer the second question first. What type of account is it? Oh, okay, it's that type, so it belongs on this financial statement. So although they have the columns in this order, financial statement, then type of account, we're going to do it the other way around because that seems to make more sense to me. So some of these we can really answer very quickly. Anytime we see the word payable, we know it's going to be a liability. This one actually says liability, so it must be a well, most of the time that would mean it is a liability. Here it says frequent flyer, these are obligations, so that's a liability. And we know that liabilities appear on the balance sheet. So I can answer all of those. As I said, there are a couple of these that I want to talk about because they are situations that we have not yet seen, and so you need to be aware. I want to explain them to you. So, advance payments for equipment. Advance payments for equipment. So this is something that's probably maybe unique to Delta Airlines. So it's more challenging for us to figure that one out. We have a general term for this, and it is prepaid expenses. Prepaid expenses. We will see this not only in this context of paying in advance for equipment, but it could also be paying in advance for, oh, and we actually see right down here at the bottom, prepaid expenses is a category on its own. So once we explain this, we'll be able to explain and answer that one. It'll be the same answer. So we have paid in advance for something, maybe it's a lease payment, and we now have the right to use that, in this case, equipment, for some specified period of time. So it's not something we own, but it's something that we control because we've leased it. As I said, we'll see this prepaid expenses concept in a couple other areas as well. We typically think of prepaid rent and prepaid insurance as two of those. So if you have a car, you might be familiar with this already. That usually when you get car insurance, you get a 6-month policy. And sometimes if you have the cash, you might choose to pay the whole 6-month premium up front because maybe you get a discount, or maybe they charge you an installment fee if you choose to pay it by the month. Okay? So not all insurances work that way, but that is something that you might see with car insurance, if there's a incentive to pay the whole thing in advance. For companies, you frequently will see that they will pay for the full 6 months or year of the policy up front. And then it becomes, here's the answer to our question, then it becomes for us an asset because we now have that insurance policy, or in this case, we have the right to use that equipment for some set period of time. And then as we use that equipment or use the building that we're renting or have the insurance policy in place and time passes, that asset is gradually going to turn into an expense. So just because you see the word expense here does not mean that that is an expense, and that can be confusing. Instead, it is an asset because we have paid in advance for something that we now have a right to use that to help us make money. That is our definition of an asset. Because it's an asset, it goes on which of these financial statements? The balance sheet, exactly. And so you can go ahead and put those same answers in for prepaid expenses. I've given you a couple examples of what those prepaid expenses might be. Typically what we see is rent and insurance, but I guess it could be lots of other things that you pay for in advance. I think there was another one. There was another one. I thought there was another one that I wanted to make sure we covered. But I think from here, you should be able to complete this exercise. You know, if you see cargo revenue, you know that's going to be a revenue account. And because it's a revenue account, it's going to go on the income statement. So at the end of chapter 1, we had talked about, at the very end of class, what goes on those 3 financial statements, not including the cash flow statement, because we don't get to that really until chapter 13 at the end of the semester. But you should be able to finish this one up on your own. Does anyone have any questions, though, about how to go about finishing this? Okay. I'm just going to click the check my work button just to get the green check marks in there. So we don't see any red X's, but I can tell looking down here at my assignment score that I didn't finish that. I'm reminded it's not done because when I see this button right here, it's half green. It doesn't have the check mark in it yet. So I know that that one's not finished, and that will remind me to come back and finish it at a later date before I submit this assignment. And let's keep moving. Now for this exercise, you can again see it as a multiple choice exercise, but this one's short, we are going to do this whole thing together. You may find it helpful to refer back to this that we went over a few minutes ago, but I'm also going to talk you through it. And what you will see is if you understand what it means to be a normal balance, you can actually fill out this entire exercise without having to refer back to that expanded accounting equation with normal balances. So let's just go through these one at a time. For an asset, we're given that it decreases on the credit side, so it must be the case that it increases on the debit side. Because one side increases, the other side decreases. That must be the case, right? Everybody agrees with that? And the side that increases that account is always the normal balance. So whatever's in this increase column has to be the same as what's in the normal balance column. And it has to be the opposite of what's in the decrease column. With that said, I want you to keep in mind the reminder, the mnemonic that I gave you. Assets equals liabilities plus equity. And we know that dividends and expenses don't follow the rule because they reduce our equity. Even though they're on the right-hand side of the equation, they have minus signs in front of them, they reduce our equity. So they have the same normal balance as assets on the left-hand side. Assets have a normal debit balance. Liabilities have a normal credit balance because they're on the credit or the right-hand side of that equation. Liabilities increase on the credit side, they must decrease on the debit side. Nobody's born knowing this. If you are thinking right now, how am I supposed to remember that? You aren't supposed to remember it the first day we talk about it. If you do, great, that's fantastic. But it's not an expectation that you remember it today. That's why you have this here for reference. That's why I'm reminding you about the position of that equation, because it should help you to remember. What I can tell you is for the vast majority of people, if you keep working with this, keep referring to that picture, that graphic in Blackboard, eventually you will just know it because you've done it so many times. But nobody's born knowing this. For some of you, it will make sense. It's just maybe how your brain works. So just like some people are math people and some people are English people and some people are art people and some people are history people. Not everyone has an accounting brain, and that's okay. It's fine. You can do fine in this class without having a math brain or an accounting brain, because I'm giving you the tools so that you know where to look to remind yourself, even if you don't memorize it. That's okay. Common stock has a increases on the credit side, so that must be the normal balance. And if it increases on the credit side, it must decrease on the debit side. How do we know that? Because it's an equity account and it's on the right hand or the credit side of the equation. Retained earnings is also on the credit side of the equation. So we know it increases on the credit side. We're already told that's the normal balance. And if it increases on the credit side, it must decrease on the debit side. Dividends. Now we know that dividends reduce equity. So they have the opposite normal balance of the other equity accounts, common stock and retained earnings. So they increase on the debit side and their normal balance is debit. Revenues increase equity. Equity is on the right hand or the credit side of the equation. So they increase on the credit side and must then decrease on the debit side. And finally, for expenses, expenses are on the right-hand side of the equation, but they reduce our equity, and so they have the opposite normal balance. They have a normal debit balance, and they increase on the debit side. Put my green check marks in there. I like to get my full credit for that exercise. So again, even if you don't have this memorized, does it make sense how these relate? Does anyone have any questions so far? Everybody's good? Maybe clear my picture there and we'll keep going. So this is another exercise that obviously is a multiple choice question, and I am going to ask you once again to do this one on your own. And there are no accounts there that I think need further explanation. We've talked about all of them. It's the only one that I will point out. We'll use this as our example to make sure you know what's expected for this exercise. We're going to use letter F. As you'll hear me say, if you have not already, I generally, when an account title includes the word fees in it, I'm going to be annoyed by that because sometimes it's unclear what they mean. This specifically says fees earned. So this represents amounts we've charged our customers for services we've performed probably. And so this exercise is like in services company. These fees earned represent amounts that we have earned from our customers for the services that we performed, and that is our definition of a revenue. Now you can see in this exercise, if you look at that drop-down list, for each account title, you're asked to pick from these 5, actually, is that it? Just those 5, yeah, account titles. And once you choose the type of account, then you should be able to identify the normal balance. So remember, the normal balance is the side that's going to be used to increase that account. Revenue is on the credit side of the equation, on the right-hand side of the equation. And so revenues have a normal credit balance. So you need to be in the habit of asking yourself those questions. Please don't be in a hurry and want to drop out questions thinking they're unnecessary. You need to know what type of account it is to know what the normal balance would be. There's no merit in trying to jump right to what's the normal balance. Because if you don't know what type of account it is, you can't possibly answer that question. The type of account dictates what the normal balance would be. So please just take it slow. Ask yourself the necessary questions. Eventually, it will probably be that you don't have to consciously ask yourself, oh, what type of account is that? Because you'll just get used to it. But for now, please go through each one of the steps. What type of account? Okay, what does that tell us about the normal balance? I'm going to put my green check marks in for that one, and I'm going to keep going unless there are any questions.
For the dividends, would it be an account of an expense?
Good question. So I'm going to rephrase it. Is dividends an expense account? And if so, why don't they put the word expense on it like they do with rent expense and utilities expense? And so that leads us to believe, well, maybe it's not an expense. Maybe it's something else. And dividends is actually its own form of account. So it's like an expense. You can see that here because they've listed it separate from the expenses. So it is like an expense in that it has a normal debit balance, that it reduces equity, it reduces our retained earnings. But if we think about the definition I gave you in chapter 1 for an expense, so let's see what they give us the definition here. Assets used up, well, that's kind of a good definition. Assets used up or services consumed in the process of generating revenues. And that's similar to what I usually say, which is it's the costs that help us generate the revenues. So the key phrase there is used in generating revenues. Well, dividends do not help us generate revenues. I think it's probably true that our customers, for the most part, don't even know whether we pay dividends, because some companies do pay dividends and others do not. And usually what I ask people to do is think about what you're wearing. And if you can think of a name brand of anything that you're wearing, maybe you're wearing Nike sneakers, maybe you're wearing a sweater that came from, I have no idea where people buy things, Old Navy or the Gap or whatever. Do you know if those companies pay dividends? Do you know if Nike pays dividends to its shareholders?
I mean, probably.
So you can take an educated guess, in a pure probability, 50-50 chance, right? It's either yes, they do, or no, they don't. So you can guess, and many companies do pay dividends. So probably more companies than not pay dividends. So if you guessed yes, you statistically are probably more likely right than wrong. But we don't know that. And I can see, Michael, you actually are wearing Nike shoes. So do you know if Nike pays dividends?
No.
Does it impact your buying decision at all?
No.
No. No. And so the answer is, to the very long, apparently, answer to the very short question, isn't dividends an expense? The answer is no, it's not an expense because they don't help us make money. They don't help us generate revenues. They have nothing to do with providing service or selling a product to our customers. It's really, dividends are about our stockholders, our owners. And so we'll talk more about dividend policy in chapter 12, which is the stockholders equity chapter. But for now, that's a really good question because they are very much like expenses in the way they affect our financial statements. However, they're not an expense. They don't show up on our income statement. One of the reasons this is really significant for the corporate form of organization is something known as the, it's on the screen, double taxation of corporate profits. This is one of the negatives, one of the drawbacks of the corporate form of organization is the double taxation of their profits. You may have heard that term and really not known what it meant. Maybe you've never heard the term before, and that's okay. What it means is dividends don't appear on the income statement. They're not part of the cost of doing business for the company. They're not tax deductible. So when you were a corporation, you pay tax, and I don't want to be too specific because, as I've already mentioned, there are some differences between financial accounting that we're learning and tax accounting. This is not one of those. They basically pay tax on what's on their income statement. There are some tweaks because tax accounting is different. But for the most part, you look at their income statement that tells you what they're paying income tax based on those earnings. Then with their after-tax earnings, they pay dividends if they choose to. They pay dividends to their shareholders. And those dividends are then taxed again as income to the shareholders, as earnings to the shareholders. Is that ordinary income? There are some tax advantages. You might be taxed at a lower rate or possibly not at all if you are a lower income earner. But they are still taxable at the recipient, at the stockholder. So the earnings are taxed at the corporate level. Remember, we talked in chapter 1, corporations are people in the eyes of the law. They pay taxes. And so they pay taxes on their income. And then with what's left, they may choose to distribute some of that to their stockholders as a thank you, as a reward, as a gain for being invested in the company. And then the stockholders likely pay taxes on it again on that money that's already been taxed. So that's what that concept of double taxation of corporate profits, it's a drawback. If you are a sole proprietorship or a partnership, that income is only taxed once because the sole proprietorship or partnership is what's called a pass-through entity. So the business doesn't really make any money. Those earnings are passed through the business to the owner or owners of the business, and the owners pay taxes on those earnings, but only once. That's how a corporation is different. One way a corporation is different. Definitely a drawback that you're going to pay tax on those, that they are taxed twice. Does that make sense? And I'm sorry, I didn't see who asked that question, but someone on Zoom who asked the question about our dividends and expense. That was my super long answer about why they're not. Does that make sense to you?
Yes, it does. Thank you.
Yeah, you're welcome. So dividends are its own type. For our purposes here, we're going to classify it as stockholders' equity. But it is its own type of account under stockholders' equity. We can see that here, its own type of account. But it does have a normal debit balance because it reduces our equity. The more dividends we pay, the less earnings we retain. So I'm glad you asked that question because it is definitely a little different. So you should be able at this point to finish up that exercise on your own later. And let's go to our next exercise. So for these exercises, what I am going to do is draw some T accounts on the board, or excuse me, on the screen. Even though we've been doing this for 2 years now, I still spent a lot more of my working life, my teaching life, using the whiteboard in the classroom than I have writing stuff on the Zoom screen like this. So some of my terminology is still off. So what I'm going to be doing is putting some T accounts on the board, on the screen, and talking through what happened here. So I'm going to be doing a little bit more than what is strictly necessary to answer these questions, because I want you to be thinking about how all this stuff gets in the accounts in the first place. So the account that we're really dealing with here to answer this specific question is accounts payable. And I think I have told you before that the standard abbreviation for accounts payable is AP. Accounts payable is what type of an account? It's a liability. Accounts payable is a liability. And because it's a liability, it has a normal credit balance. So I said, at least for a week or so, I will be labeling these just so that we're used to that. At some point though, I will stop labeling them once it feels like people are comfortable with that and you've seen it enough times. But for now, we'll label them just as a refresher, as a reminder. So we put I drew the T for the T account. I put the title on the top where it belongs. I labeled the debit and credit side that's just left and right. And I put the plus sign on the normal balance, or the side that we use to increase the account based on the type of account that it is. Everybody good so far? Okay. So I am going to assume, I'm just going to make up a couple other account titles here that we're going to use to talk about what happened here. Okay. And I'm going to take these somewhat out of order possibly, just so that it makes sense to us what's happening. So let me label under the inventory account, I'll label the debit and credit side. Inventory is what type of account? What type of account is inventory? Stuff we have that we have available to sell to our customers, right? It's an asset. It's going to help us make money when we sell it to our customers. So because it's an asset, it has a normal debit balance. And for the cash account, I'll label the debit and credit side.
So for inventory for large shoes like Walmart or whatever, where they have the pointing stuff, wouldn't that be also a liability? Or not really?
Having to pay for it. We're going to see that when we actually analyze what happened here. But they have to pay for it, and the having to pay for it is the accounts payable. That's the liability. The inventory itself is an asset because they have it available for, it's something they own or control that's going to help them to make money when they sell it to their customers. So I think that will make more sense, exactly what that means. Cash, we've talked about a number of times. Cash is certainly an asset account, so it has a normal debit balance, increases on the debit or the left-hand side. Okay. As I said, I am going to do these a little bit out of order. Okay. But I'm going to read through the whole letter A first. During February, we paid our creditors some amount. So we owed some money, we paid it. We bought some more stuff on account, which means we owe for that stuff. And at the end of the month, we know what the balance was in the accounts payable account, and we're asked to find the beginning balance. So if I look at this accounts payable account, here's the part we don't know, the beginning balance. So why did I put that on the credit side? Well, because accounts payable has a normal credit balance. I'm assuming it started with a credit balance. It's the normal balance, so we assume that's what the balance is most of the time. Now, many of the accounts actually could end up with a balance that's different than the normal balance. Some of them it's probably not feasible, but how would our cash account end up with a normal, with a credit balance? It has a normal debit balance, but if we overdrew our account, right, it would have a credit balance. Not normal. We hope that doesn't happen, but that's how it could happen. So when it says, it asks us to find the account balance on February 1st, I'm putting a question mark there. That's our unknown. That's what we're asked to find. Then I put it on the credit side because I'm just assuming it's going to have a credit balance. Since we're working now on transaction analysis, that's the focus of this chapter, I'm doing, as I said, a little bit more than we need to do strictly to answer this question. To answer this question, we could just look at what happens in that accounts payable account, but I really want you to be comfortable with the idea that every transaction has to affect at least two accounts. And so if we look at only the ones that impact the accounts payable account, it's easy to ignore what else happened. And I really want you to start out from day one of transaction analysis, that's today. I really want you to start with the understanding that it can't just be one account, it has to be at least two. And so again, we're going to do a little bit more than what's strictly necessary to answer this question. So purchases on account. I'm making an assumption that what we bought from our suppliers is inventory. And so when we buy stuff on account, we know it's going to affect at least two accounts. What's going to be affected? We bought some inventory on account. Inventory is going to increase. We heard in the classroom from Michael, inventory is going to increase. So we already noted that inventory, it's an asset. It has a normal debit balance. So to increase the inventory account, we're going to record the dollar amount. Remember, we talked about in chapter 1 the concept of money measure. And in the United States, we are going to be using dollars. So you'll notice I did not put a dollar sign there. It is understood that the dollar amounts, the values, the amounts, the numbers that we record in T accounts, it's understood those are dollars. So we don't need to label it. It's actually incorrect to put a dollar sign in a T account like that. We know it's dollars. So inventory increased because we bought some stuff, but we bought it on account, so we haven't paid for it yet. So what else is going to happen? What's the other account that's going to be affected? Liability. And the liability that we're going to use is accounts payable. So we owe, thank you, Marcia. So let me get the chat opened over here so that I can keep track of that as well. It's not blocking the rest of my stuff. Okay, so accounts payable is the correct answer. So accounts payable, liability, normal credit balance, to show that we owe people more than we did before this transaction happened. We record it on the credit side to increase that liability. So Stephen, to your question, you can see now that we bought some inventory and our balance sheet shows, yes, we have the inventory, we increased the asset, but we also have to pay for it. And so we increase the liability. So do you see how that, I think that's the question you were asking about, isn't it a liability for us? It is, and we reflect that liability in the liability account, accounts payable. Does that make sense?
Yeah.
Any other questions about that transaction? That's really the first transaction we have recorded in T account. So what's the other thing it tells us in this exercise? $186,500 was paid to creditors on account. So we owe right now, we don't know how much we owed in total because remember, we don't know the beginning balance. But we added to that balance another $201,400 when we bought that inventory from our suppliers. Now that's probably not just one purchase. It might be multiple purchases throughout the month of February. We are just looking at it as a combined entry. That's okay. Could be just one purchase for the total. But when we make the payment, what happens? Again, we know we have to affect at least two accounts. What's one of them? What do we use to make the payment? Cash. So remember I said that cash account could be our our checking account. Okay, so it doesn't necessarily mean bills and coins that are sitting around. I don't mean to imply that we packaged up $186,500 in cash and sent it off to our suppliers. The cash account is really an accumulation of those accounts. And we'll talk about that more in chapter 7, which is the cash and internal control chapter. So do we have more cash now or less than we had? We have less. So cash is an asset. To show we have less of it, we need to record it on the credit side. We need to record that on the credit side to reduce the amount of cash. Now you'll notice that we didn't start with a beginning balance in our cash. It's just because I'm making this stuff up, right? I'm only showing the transactions. But remember, I drew the distinction, if I were, whoops, all right, if I were to go back over here, I drew the distinctions that assets, liabilities, common stock, and retained earnings are permanent accounts, and dividends, revenues, and expenses are those temporary accounts. The fact that these are permanent or real accounts, or the balance sheet accounts, it means they carry their balance forward. So whatever the cash account had in it at the end of January, it will also have in it at the beginning of February. The balances carry forward. For those temporary accounts, dividends, revenues, and expenses, those balances do not carry forward, and we'll address that in an upcoming chapter. So what happens to them? Where do they go? How do they get to zero so that they don't have a balance in them carrying forward at the end of the month? Okay, so we used $186,500 of our cash. That's one of the accounts that's affected. We have a credit, but remember, we need a debit to balance against that. We need a debit for the exact same amount. So what other account is affected here? Accounts payable. So, and Marcia, I just saw your note in the chat. Yes, that's correct. We decreased cash. So accounts payable. Is our accounts payable liability going to go up or go down? Do we owe more or less? It's going to go down. We're going to owe less. We just paid off part of our balance, right? Part of what we owed. So accounts payable is a liability. It has a normal credit balance. To show that it went down, we're going to debit accounts payable. Now, it does not matter. You'll notice I'm putting this dollar amount on the first open line on the accounts payable side of the T account. It does not need to be below the entries that are on the credit side. We just use the first available line on the correct side. And if you think back, I think I still have it here. You see these transactions, lettered A and D, and over here we have B, E, and F. So probably transaction, well, I can't point it out here because they do still kind of go in chronological order. But it is possible that this could have had a letter J there instead of a D, and it would be okay that it was above the E, F, and H marks, okay? We use the first open line. Remember, we've said that the T accounts don't actually show up like this in our accounting records anyway. These are just for us to use to see what happened, to visualize what's happening. So I wrote the debit to accounts payable on the left or the debit side on the first open line. So let's look at that transaction. We have a debit for $186,500 and we have a credit for $186,500. So I'm happy with that because they balance. We had an asset, cash, go down, and the liability went down by the same amount. So our balance sheet, our equation remains in balance. What happened in the first transaction? Our asset inventory went up, but our liability accounts payable also went up. So our equation stayed in balance. An asset and a liability both increased by the same amount. What if we had just paid cash for the inventory in the first place? Well, then the debit to inventory would have been the same, but the credit, rather than going to accounts payable, if we paid cash for it, the credit would have been to cash, right? So the inventory asset would go up, but the cash asset would go down by the same amount. Our total assets would remain unchanged. Our equation would stay in balance. So just as we said at the end of class last time, every transaction is going to affect at least two accounts, but it doesn't have to be two different types of accounts. It could be two assets or two liabilities or two equity accounts. Or it could be an asset and a liability, an asset and an equity, a liability and an equity. It could be any combination as long as we follow the rules that we have at least two accounts and the total debits and the total credits are the same, are equal, then our equation will stay in balance. Questions at this point? Is this making sense? Okay. So then we are told that we, at the end of the month, draw that down a little bit more. Then we are told that at the end of the month, the balance in accounts payable was $59,500. $59,500. Sorry, $59,900. Said the wrong thing, wrote the right thing. How did I know to write that on the credit side? Well, it didn't tell me, but I'm making an assumption. If it doesn't tell you what type of balance it is, it would be the normal balance. If it was a debit balance, what would that mean? It would mean we paid more than we owe, right? That's the only way to get a debit balance in a liability is to overpay that liability. Not likely to happen. If it did happen, if it had a debit balance, which is not its normal balance, they would need to tell us. Okay. And that's, again, not likely to happen, that we paid more than what we owed. Okay, so we're kind of doing this next step in reverse because it will never be the situation that we would know the ending balance and we would know what happened during the month and we didn't know the beginning balance. We know the beginning balance from literally from day one of the month because it's whatever the balance was at the end of January becomes the balance at the beginning of February. So as will frequently be the case, what we're looking at here is not a realistic scenario, but the reason we do them is because it helps us to remember how this works. Helps us to figure out how the pieces of the accounting puzzle fit together. So what do we know? Well, we only have one debit. So remember, I walked through briefly how we find the balance in the accounts. We have to find the debit footing and the credit footing. Well, I don't know what the credit footing is because I've got that question mark there, but I do know what the debit footing is because we know everything that happened on the debit side of that account. So I can stick the debit footing in there. Well, what else did I tell you? Well, to find the balance, we subtract the smaller footing from the larger footing. And then we record the balance on the side that had the larger footing. So because I recorded this balance on the credit side, I know that the credit footing was higher than the debit footing, right? Has to be. Has to be higher. How much higher? Well, about $60,000 higher, because when I subtracted 186.5 from the credit footing, I was left with 59,900. So if I just add those two things together, 186.5 and 59.9, I get 246,400. And if I'm not sure that's right, I'm going to do it in the normal order and see if it makes sense. I'm just going to round off and talk it through. I owed $246,400 to my creditors. During the month, I paid off $186,500, and so at the end of the month, I still owed about $60,000. Yeah, that makes sense. We owed about $250. We paid $180, $190, something like that, rounding off, and we still owed $60. Sure, that makes sense, doesn't it? Okay. So now I can find that question mark. In total, we owed $246,400 during the month. $201,400 of that was the new charges, the new stuff we bought on account. So if I subtract the new purchases, $201,400, from the total that we owed, that will give me the beginning balance. Did anyone find that? What do we think the beginning balance was?
$45,000.
45,000, yep, and Marcia posted it in the chat as well, thank you. 45,000 must have been the beginning balance. Again, if you're not sure, if you just want to reassure yourself, yes, you can click the check my work button. But we could, what else could we do? Well, let's just walk through it, talk through it, make sure it makes sense. We owed 45,000 and then we bought another 200,000 on credit. So we owed about 246,000. We paid off 186, and sure enough, we owed still about 60,000 at the end. And I'm just rounding off and checking for reasonableness. Does this even make sense? And it does to me. Does it to you? I'm going to clear my pictures. If everybody's okay, we'll move on to the next one. Everybody good? All right, let's look at letter B then. On October 1st, on October 1st, our accounts receivable, so I'm drawing in my T account here. The normal abbreviation, the accepted abbreviation for accounts receivable is AR. Remember, accounts receivable represents amounts that are owed to us by our customers. Usually we've allowed them to buy on credit and they agree to pay later. And so this represents the amounts that they still owe to us. So accounts receivable is an asset. So as I said I would, I'm just labeling the debit and the credit side to remind us it's the left and the right respectively. And I put the plus sign on the side that is used to increase that account or the normal balance for that account. So let's see, what other accounts might I want to use here? Let's use, whoops, sorry. Just put a couple more accounts on here for us to use to talk through what happened so we can get in practice of seeing both sides of a transaction. So I'm just going to call that revenue, and I'm going to call this one, whoops, cash. Okay, so revenue is a revenue account. I'm just going to label the debit and credit sides. It's the same thing for the cash as long as I'm here. Whoops. And then I'll put the pluses and minuses in. So revenue has a normal credit balance, and cash has a normal debit balance. I know that's true because revenue is on the credit or the right-hand side of the equation, and it increases our equity, so it has a normal credit balance. Cash is on the left hand of the debit side of the equation. It's an asset, so it has a normal debit balance. So let's read what happened here. Everybody with me so far? Let's read what happened. On October 1st, the accounts receivable account balance was $115,800. Does not tell us whether that's a debit or a credit balance, so we will assume it is the normal balance for that account. We'll assume it is a normal debit balance. During October, $449,600 was collected from customers on account. So we know that this is a transaction, and this is a collective, this is a combined or consolidated summary transaction. We would normally record this, but we would need to record it every time a customer paid us, because we need to know that A customer paid us and B customer still owes us and C customer made a partial payment and so on. So we're looking at this in summary just to get the idea. So we know that that transaction, we know it's a transaction because it affected the financial position of our company. Something changed in our company. Anytime cash changes hands, it automatically, by definition, is a transaction. So we know it's a transaction, we know it needs to be recorded, we know we have to have at least 2 accounts. So what's one of the accounts that is affected when we collect from our customers on account? Cash. Stephen, is our cash going to go up or down? Up. So when we collect from our customers, we would record that on the debit side of the cash account to show that we have more cash than we had before these customers paid us. The asset cash has increased by about $450,000. What else happened though? Something else had to happen because we can't have just one account. We can't have just a debit without a credit. Why did those customers pay us? Yes. Yep. So they paid us because they owed us. How do I know they owed us? Well, because it's recorded, or would be recorded in our accounts receivable. They would not have paid us if they didn't owe us. Once they pay us, do they still owe us? No. That'd be kind of a cool trick, right? Well, you paid us, but could you just pay us again? No. Unfortunately for us as a business, once they pay us, they no longer owe us. And so as Stephen said, accounts receivable is going to go down. Those customers no longer owe us, so we need to remove that from the accounts receivable. We need to credit their account to show they don't owe us anymore. Now again, this is one of those situations that we frequently encounter where the information they give us is not really in the order that it would actually happen. There's no way that we would know at the end of the month how much our customers still owed us if we didn't know how much we had billed them in the first place. But we're going to be asked to fill in the blank here. Assuming the October 31st balance was $130,770, determine the fees billed the customers on account during October. And so this is what we're trying to find. How much did we add to our accounts receivable during the month of October? We know the beginning balance, we know how much we took out of the account, credited, and we know the ending balance. So we're trying to find this. Well, the amount that we billed to our customers would be the same amount as the revenue that we earned from those sales. I don't know what we're selling to our customers, some product or service. And when we billed them for it, we would have been recording the revenue that we had earned and the receivable. And so I'm just putting the question mark here in the revenue account to remind us that that's the other side of that transaction. Why did we bill them? Because we earned a revenue, because we sold them something, whatever it is we're in business to sell. So how are we going to find this balance? We're going to follow the same strategy we followed in part A. And I have 2 minutes to get this done. So we know to balance the account, we need to find the debit footing and the credit footing. I can't find the debit footing because I have that question mark in there. So I'm going to put in the credit footing because I don't have any unknowns there. I only have just that one. Again, we said that's a summary entry, so there'd actually be maybe dozens or hundreds possibly of credits here as we received all those payments. But they've already been added up for us. I can't find the total of the debits, but what do I know? I know the ending balance and I know the credit total. So to find the debit footing, it must be the total of the credit footing plus the ending balance. So 449.6 plus 137.70 . And it is 580,370. Is that what everyone else got? 583.70. First day with the new calculator. I'm just trying to make sure I'm doing it right. I'm just not used to it. When you've used the same calculator for literally 30 years, and then you have to switch, it's a big thing. Now we can find that question mark, because we know the total of the beginning balance plus that question mark must be 580,370. So if I take the debit footing, 580,370, and subtract the beginning balance, 115,800, it should give me the amount that our customers charged this month, 464,570. How much did we bill our customers this month? If you, and I realize we're out of time, but if you are not sure about that, just talk yourself through it. They owed us about 120,000 at the beginning of the month. They charged another 470,000. They paid off about 450,000. They still owed us 130 at the end of the month. Those numbers seem reasonable to me. To end our class for today, then I'm just going to click the check my work button, get our green check marks. When we come in next time, we'll start with letter C and go through that quickly. Feel free to try that on your own. Don't forget you have the rest of the first 3 exercises to complete on your own as well. Any questions before we call it a day? All right. Well, thank you all for being here, and I hope to see you next time.